Australia's gold production is about to explode, a massive 30% jump by 2030, from 10.2 million ounces today to 13.2 million ounces. That's an additional 3 million ounces of gold flowing from Australian mines over the next 5 years. But here's what makes this surge absolutely extraordinary. It's happening against the backdrop of 5 consecutive years of production declines. So what's changed? What's driving this dramatic reversal? The answer lies in a handful of game-changing mines, multi-billion-dollar expansions, brand-new discoveries, and strategic acquisitions that are reshaping Australia's gold landscape. These aren't incremental improvements. These are transformational projects that will cement Australia's position as a global gold powerhouse. The numbers tell an incredible story. Australia currently produces around 10.2 million ounces annually, making it the world's second-largest gold producer after China. But production has been falling steadily since 2020, year after year of decline as older, high-grade deposits depleted and grades at major operations fell. The 2025 figure of 10.2 million ounces represents a 0.1% decrease from 2024, continuing a troubling trend that had analysts questioning Australia's gold future. Yet global data, the industry's leading mining intelligence firm, forecasts a compound annual growth rate of 5.4% between 2025 and 2030. That's not gradual growth, that's explosive expansion. Production hitting 13.2 million ounces by 2030 represents approximately 30% growth from current levels. To put this in perspective, this single 5-year period will add more new gold production than many countries produce annually. What's driving this transformation? Major mine expansions, new project developments, strategic consolidation through mergers and acquisitions, and critically, surging gold prices that make previously marginal projects economically viable. Gold hit $4,071.38 per ounce in November 2025, up a staggering 57.19% from the same point in 2024. At these price levels, projects that seemed questionable at $2,000 gold become absolute no-brainers at $4,000 plus. Let's dive into the specific mines and projects creating this production surge, because understanding where this gold is coming from reveals the strategic positioning happening across Australia's gold sector. First, the Super Pit at Kalgoorlie. Northern Star Resources' crown jewel operation is undergoing a transformational $1.5 billion expansion at KCGM, the Kalgoorlie Consolidated Gold Mines. The company is doubling processing capacity at the Fimiston Mill from its current throughput to handle massive volumes, targeting production of 900,000 ounces per year once fully operational. That would make it not just Australia's largest gold operation, but the 4th largest gold mine globally. The KCGM operation already contributed 222,236 ounces in just the June 2025 quarter alone, approximately 50% of Northern Star's quarterly output. Production from KCGM is projected to deliver 550,000 to 600,000 ounces in the 2026 financial year, representing roughly 1/3 of Northern Star's total gold production. The expansion, with commissioning beginning in the 2026 financial year, will ramp underground mining volumes to an impressive 3 million tons annually. But here's where it gets really interesting. Northern Star isn't stopping at Kalgoorlie. The company completed a landmark $5 billion takeover of De Grey Mining in May 2025, securing one of the most significant undeveloped gold assets globally, the Hemi Gold Project. Hemi changes everything. Located in Western Australia's Pilbara region, approximately 60 kilometers south of Port Hedland, Hemi represents one of Australia's largest gold discoveries of the past decade. First discovered in 2019, the deposit boasts 11.2 million ounces of mineral resources and 6 million ounces of ore reserves at a grade of 1.5 grams per ton. The production profile? Absolutely massive. Hemi is forecast to produce 530,000 ounces annually over its first decade of operation, with peak production hitting 553,000 ounces across the first 5 years. Construction activities commenced in the second half of 2024, with first gold production targeted in the second half of 2026. When Hemi reaches full production in 2027, it will rank among Australia's top 5 gold-producing mines. Combined with the KCGM expansion, Northern Star's production trajectory becomes clear. The company aims to reach 2 million ounces annually by the 2027 financial year, then propel production to approximately 2.5 million ounces per year by 2029 when Hemi contributions are fully realized. That's not just company growth, that's a fundamental reshaping of Australia's gold landscape. The scale of Hemi deserves emphasis. At an estimated production capacity of 553,000 ounces per year once fully operational, Hemi would rank third in Australian gold production behind only Newmont's Boddington and Cadia mines. The definitive feasibility study released in September 2023 calculated a net present value of $4.2 billion pre-tax and $2.9 billion post-tax, with an internal rate of return of 45% pre-tax. Capital costs total approximately $1.3 billion for initial development. De Grey raised $600 million through equity in May 2024 and secured close to $1 billion in senior debt facilities with a $130 million overrun facility. The project utilizes pressure oxidation technology to process the refractory ore, a complex but proven method used in approximately 40% of global gold production. Northern Star's managing director Stuart Tonkin emphasized the strategic importance. This reinforces Northern Star's position as the leading Australian ASX-listed gold company and a top 10 global gold major. The acquisition cements Northern Star's transformation from regional producer to genuine global heavyweight. But Northern Star and Hemi aren't the only drivers of Australia's production surge. Newmont Corporation's Cadia operation, already one of the world's largest underground gold and copper mines, continues expanding. Cadia produces nearly 600,000 ounces of gold annually, along with significant copper production, making it Australia's largest underground mine. Located near Orange in New South Wales, Cadia has been a cornerstone of Australian gold production for decades. The mine currently operates using large-scale panel caving methods at the Cadia East underground operation, one of the world's largest gold and copper deposits. What makes Cadia critical to the 2030 production outlook? Newmont's application to extend operations from the current 2031 permit expiration to 2050. While Cadia is currently approved to continue operations until 2031, mineral resources have been identified for production extending to 2048-2050. The company submitted a referral application under the Environment Protection and Biodiversity Conservation Act, proposing to utilize both existing and new infrastructure, alongside ongoing underground mining at Cadia East and Ridgeway sites. If approved, the extension will secure more than 2,100 full-time jobs and ensure production continuity. Cadia's 2024 reserves stand at 14.1 million ounces of gold, down slightly by 4%, primarily due to depletion of 0.6 million ounces, but still representing a massive resource base supporting decades of future production. The mine's significance extends beyond pure production volume. Cadia also produces a large share of Australia's copper and operates Australia's only molybdenum mine. This diversification provides economic stability and positions the operation to benefit from multiple commodity price movements. Newmont's second quarter 2025 results showed Cadia production slightly stronger than expected in the first half of the year, though production is anticipated to decline somewhat in the second half as the mine transitions between ore bodies. The operation is currently advancing underground development for Panel Cave 1-2, following completion of Panel 2-3 draw points. Beyond Northern Star and Newmont, numerous mid-tier and emerging producers are contributing to the production growth. Ramelius Resources provides a perfect example of operational expansion driving output increases. According to Ramelius Managing Director Mark Zepner, production from the Mount Magnet mine will grow from 185,000 to 205,000 ounces in the 2026 financial year to 200,000 to 220,000 ounces in FY27, before jumping significantly to 280,000 to 310,000 ounces in FY28 as more ore from the high-grade Never Never deposit at Dalgaranga gets incorporated into the Mount Magnet mill feed. The company's Rebecca Row project will contribute additional production from 2029. For both projects combined, Zepner guided production of 500,000 to 550,000 ounces in FY30, with expectations to sustain that production level for at least 5 years. That's a mid-tier producer punching well above its weight class. Evolution Mining is another company advancing significant growth projects. Executive Chairman Jake Klein stated that Evolution plans to advance projects at Ernest Henry and North Park's mines that will either extend mine life or increase production rates. At Mungari, production will increase by 50% following successful commissioning of the process plant expansion project. At Cowell, the company is starting the open pit continuation project, extending mining operations by 10 years. These aren't minor tweaks, these are fundamental capacity expansions. West Gold Resources is bringing the Great Fingal project online, which remains on track to start operations in the first half of 2025, with anticipated annual production of approximately 43,500 ounces. While not massive by itself, projects like Great Fingal collectively contribute meaningful volume to the national total. Regis Resources' McPhillamys project, located just 20 kilometers from Newmont's Cadia mine, is set to start producing from 2028, when it's forecast to produce more than 38,000 ounces of gold, increasing to 76,170 ounces by 2030. The project has navigated complex regulatory approvals but appears positioned for development. In Queensland, the Ravenswood mine has undergone recent expansion, experiencing a remarkable 99.5% increase in gold production between 2020 and 2024, according to global data. The mine is forecast to produce 183,700 ounces in 2025, increasing by 5.97% to 195,000 ounces in 2027. Queensland also hosts Evolution Mining's Ernest Henry mine, which produced 195,670 ounces in 2024, and multiple other operations contributing to the state's gold output. The broader project pipeline demonstrates the depth of Australia's gold development. Global data identifies 11 gold projects with a high chance of becoming operational by 2030. These include Northern Star's Yandal project, expected to start producing up to 102,500 ounces per year from 2025. The Trident project, also targeting 2025 startup. Multiple other developments in various stages of advancement. What's driving all this investment and expansion? Gold prices, absolutely, but also fundamental supply-demand dynamics. Alfie Shaw from Global Data explains, always an exceptional commodity, gold bucks the typical supply-demand curve. Usually, when a commodity experiences high prices, production increases, demand reduces, and prices correct. But gold producers have historically responded to price surges by actually decreasing production. Why? Because gold isn't just a commodity, it's a store of value, a hedge against uncertainty, a safe haven asset. The factors propelling gold prices higher aren't temporary blips, they're structural shifts in the global economy. Central bank reserve diversification increasing physical gold demand. Currency debasement concerns driving safe haven investment flows. Geopolitical tensions supporting precious metals premiums. Inflation expectations maintaining real asset allocation strategies. Konstantinos Venetis, macroeconomist at Global Data TS Lombard, notes that a confluence of tailwinds has propelled gold prices higher this year in defiance of rising real interest rates and sustained U.S. dollar strength. The list of factors causing higher gold prices is extensive: central bank purchases, Chinese retail demand, geopolitical turbulence, expectations of interest rate dynamics as inflation shifts. Kelly Carter, chair of Western Australia's Independent Gold Industry Group, told ABC News that there is obviously significant investment in exploration at the moment. Every producer is looking at how they can best capitalize on higher prices. This isn't reactive, this is strategic positioning for a sustained high-price environment. The merger and acquisition activity tells the same story. Newmont's $10 billion acquisition of Newcrest Mining in November 2023, the largest merger in gold sector history, consolidated Tier 1 assets and created the world's dominant gold producer. Northern Star's $5 billion De Grey acquisition in December 2024 followed similar logic, securing world-class undeveloped assets. Red 5's acquisition of Silver Lake Resources in February 2024. De Grey Mining's deal with Kalamazoo Resources in the same month. Canadian-based Karora Resources expressing interest in merging with West Gold Resources. M&A activity is likely to lead to further increases in gold production in Australia through 2030 as companies consolidate, eliminate duplication, and optimize operations. Around the time of the Newcrest deal, Newmont claimed the combined group would have a portfolio comprising more than half the world's Tier 1 assets with long-life operations and ample exploration opportunity. The company expected consolidation to generate $500 million in annual pre-tax synergies within the first 2 years. That's efficiency at scale. But challenges remain. The decline in Australian gold production from 2020 through 2025, 5 consecutive years, reflected real operational difficulties. Declining head grades at major mines, including Newmont's Boddington, Tanami, Telfer, and Agnico Eagle's Fosterville. Production from these 5 projects fell from 1.79 million ounces in 2023 to 1.7 million ounces in 2024. Western Australia, where 60% of Australia's gold is located, experienced setbacks from heavy rainfall in March 2024, affecting production at mines operated by Regis Resources, Capricorn Metals, and Gold Road Resources. Weather remains an unpredictable operational risk. Cost inflation is hitting the sector hard. Northern Star's all-in sustaining costs rose to $2,522 per ounce in the September 2025 quarter, reflecting industry-wide inflationary pressures. The company projects 5% cost inflation for FY26, equivalent to approximately $100 per ounce year-over-year increase. Global gold miners experienced an average AISC increase of approximately 4.8% during the first half of 2025, with Australian producers facing slightly higher pressures. Labor costs, fuel expenses, equipment costs, royalties, all trending upward. Queensland operators in particular struggle to rein in costs, which remain above 2022 levels. The impact of royalty hikes and margin pressures continues weighing heavily on the sector. Maintaining profitability requires careful cost management, even as gold prices surge. Permitting and regulatory approvals present another challenge. While Hemi has a granted mining license, state and federal approvals remain outstanding as of late 2024. Western Australia has seen major projects hit by capital overruns and skills shortages in recent years. Execution risk is real, particularly for large-scale developments. The skills shortage affects the entire sector. Finding experienced miners, metallurgists, engineers, and technical specialists becomes increasingly difficult as multiple major projects compete for the same talent pool. Companies must invest in training, offer competitive packages, and sometimes import expertise from overseas. Infrastructure constraints can bottleneck production growth. Port capacity, power supply, water resources, road and rail access all require coordination and investment to support expanding operations. Cadia's history includes water supply negotiations with Orange City Council and disputes over treated effluent water rights. Environmental and social license to operate continues evolving. Projects must demonstrate genuine benefits to local communities, minimize environmental impact, and engage transparently with stakeholders. Newmont's Cadia operation recently earned both the Copper Mark and the Molybdenum Mark credentials for sustainable production, illustrating the importance of meeting international standards. Despite these challenges, the fundamentals supporting Australia's gold production growth to 2030 remain robust. The geology is world-class. Australia has the third largest gold resources globally, behind only Russia and South Africa. The country's mining jurisdiction rating is Tier 1, providing political stability, clear regulatory frameworks, and established infrastructure. Australian mining expertise is globally recognized. The country has developed deep technical capabilities in complex ore processing, underground mining, environmental management, and safety systems. This knowledge base supports ambitious projects like Hemi's pressure oxidation processing or Cadia's panel caving operations. Access to capital markets through the ASX provides funding pathways for projects at all scales. From junior explorers to billion-dollar producers, companies can raise equity, secure debt financing, and attract institutional investment. The depth and sophistication of Australian capital markets supports industry growth. Geographically, Western Australia dominates Australian gold production, hosting 60% of national output. The state's Kalgoorlie region has produced gold since the 1893 gold rush, more than 130 years of continuous mining. The eastern goldfields, Yilgarn-Creighton, and emerging Pilbara Gold Province contain numerous deposits, ranging from small high-grade operations to giant low-grade bulk tonnage projects. New South Wales contributes significantly through operations like Cadia and the developing McPhillamys project. Queensland's gold sector, while smaller in absolute terms, is growing through mines like Ravenswood and projects in development. Northern Territory hosts Newmont's Tanami mine, which continues as a long-life producer. The technology evolution in Australian gold mining supports production growth. Automation, remote operations, real-time geological modeling, artificial intelligence in ore sorting, advanced metallurgical techniques all contribute to extracting more gold from each ton of ore processed. Northern Star's $225 million exploration budget for FY26 reflects ongoing investment in discovery and resource definition. Exploration success continues expanding Australia's gold endowment. Recent drilling at Northern Star's operations demonstrates this. At Kalgoorlie, a new target called Golden Goose returned encouraging results, including 73.1 meters at 1.9 grams per ton and 25.6 meters at 4.0 grams per ton. At Yandal, Drilling successfully identified new extensions at the highly productive Deacon, Barton, and Plutus areas. At the newly acquired Hemi development project in the Pilbara, drilling between the Deacon and Crow deposits returned high-grade chutes, including 3.6 meters at 19.4 grams per ton and 2.2 meters at 37.5 grams per ton. These aren't just resource definition, these are potential mine life extensions and production uplifts. Stuart Tonkin, Northern Star's managing director, emphasized that exploration demonstrates strong organic growth potential across our global portfolio. The company balances exploration priorities from resource definition through to conversion, creating shareholder value by delivering low-cost resource ounces at approximately $19 per ounce discovery cost. Looking at the global context, Australia's production growth occurs as global gold trade dynamics shift. While Australian output surges, some traditional producers face constraints. Chinese production, while still the world's largest, shows signs of plateauing. South African production continues its long-term decline as deep old mines face economic challenges. This creates opportunity for Australia. If the country successfully achieves the forecast 13.2 million ounce production by 2030, it could challenge China and Russia for the position of world's largest gold producer. Some forecasts suggest Australia could overtake both by decade's end if the project pipeline delivers as expected. The implications extend beyond production volumes. Australia, as the leading gold producer, would strengthen the country's position in global commodities markets, attract additional mining investment, and solidify the nation's reputation as a mining superpower. The economic benefits, employment, royalties, export revenue, regional development would be substantial. Employment numbers illustrate the scale. Northern Star alone employs over 4,000 people across its operations. Newmont's Cadia employs more than 2,100 full-time workers. Each mine supports additional employment through contractors, service providers, and regional businesses. The multiplier effect means every direct mining job typically supports several additional jobs in the broader economy. Regional towns depend on gold mining. Kalgoorlie-Boulder, Orange, Mount Magnet, Leonora, these communities thrive when gold production thrives. The alternative, mine closures and production declines, leads to population exodus, business closures, and economic hardship. The production growth to 2030 secures and expands these regional economies. Tax revenue and royalties provide governments with resources for infrastructure, services, and development. At current gold prices, the additional 3 million ounces of production by 2030 represents approximately $12 to $15 billion in gross revenue annually at $4,000 per ounce. Even after mining costs, the profits generate substantial tax and royalty payments. Export earnings strengthen Australia's trade balance. Gold exports require no complex processing or value-adding. Refined gold bullion ships directly to international markets, particularly Asian buyers. Unlike iron ore or coal, gold prices aren't significantly affected by freight costs, making Australian gold competitive globally regardless of distance to market. The investment appeal extends to the stock market. Australian gold miners provide investors with exposure to gold price appreciation while maintaining the operational leverage that comes from fixed cost structures. When gold prices rise, mining companies' profits typically increase faster than the gold price itself. A 10% increase in gold price might translate to 15 to 20% profit growth for efficient operators. Northern Star's market capitalization recently surpassed $20 billion, making it one of Australia's largest companies. Following Newmont's acquisition of Newcrest, Northern Star became the largest gold miner on the ASX by a considerable margin. The company's share price performance reflects both current profitability and future production growth expectations. Environmental considerations increasingly influence gold mining. Modern operations must demonstrate responsibility in water use, energy consumption, land rehabilitation, and biodiversity protection. The industry's social license depends on meeting environmental standards. Newmont's extension application for Cadia emphasizes a modest increase in the mine's footprint to allow for expanded tailings storage and infrastructure relocations. Chief Sustainability Officer Susie Redelack noted that there is room within Australia's regulatory system for pragmatism and rigor to coexist in support of environmental protection, local jobs, and local communities. Renewable energy integration is accelerating. In 2021, Newcrest contracted 55%, about 650 gigawatt-hours per year, of the Rye Park 396 megawatt wind farm to supply Cadia's power needs for 15 years. The renewable power started flowing in 2025, reducing the mine's carbon footprint while stabilizing energy costs. Northern Star and other producers are exploring similar renewable energy partnerships. Solar, wind, and battery storage can reduce reliance on grid power and diesel generation, lowering both costs and emissions. The business case for renewables strengthens as carbon pricing and environmental regulations tighten. Water management remains critical, particularly in Western Australia's arid goldfields. Mines must balance extraction with sustainability, often recycling water multiple times before discharge. Some operations invest in desalination or groundwater treatment to secure supplies without impacting local communities. Tailings storage facilities require engineering excellence. The 2019 Brumadinho Dam collapse in Brazil killed 270 people and focused global attention on tailings safety. Australian regulators and companies have implemented stringent standards, regular inspections, and monitoring systems. Cadia's history includes temporary production halts following tailings wall cracks in 2012, demonstrating the caution required. Indigenous engagement is evolving from consultation to genuine partnership. Traditional owners like the Wiradjuri people at Cadia, the Orange Local Aboriginal Land Council, and numerous Aboriginal groups across Western Australia are increasingly involved in project development, employment programs, and benefit sharing. Companies recognize that cultural heritage protection and Indigenous employment create stronger communities and more sustainable operations. Ramelius Managing Director Mark Zepner captured the sector sentiment perfectly. It is a great time to be in the business of gold mining. That optimism reflects not just current gold prices, but the broader transformation underway. The 5-year decline is ending. Major projects are advancing. M&A is consolidating Tier 1 assets, and production trajectory points sharply upward. So, is Australian gold production really set to jump 30% by 2030? The evidence is compelling. Northern Star's KCGM expansion delivering 900,000 ounces annually. Hemi producing 530,000 ounces from 2027. Newmont's Cadia extending operations to 2050. Ramelius targeting 500,000 to 550,000 ounces by FY30. Evolution expanding Mungari by 50%. Regis developing McPhillamys. Westgold bringing Great Fingal online. Ravenswood nearly doubling production. These aren't speculative hopes. These are funded projects, approved developments, operating expansions backed by feasibility studies, capital commitments, and regulatory approvals. The aggregate impact, Global Data's forecast of 13.2 million ounces by 2030, represents the sum of specific, identifiable production increases. Risks exist, certainly. Cost inflation could erode profitability, permitting delays might push projects back, operational challenges can impact production ramp-ups, gold prices could correct, though structural factors suggest sustained strength. Skills shortages might constrain execution, but the diversity of projects spreading risk across multiple companies, locations, and development stages provides resilience. The transformation of Australian gold mining from 2025 to 2030 will be remarkable. From 5 years of decline to explosive growth, from 10.2 million ounces to 13.2 million ounces, from questioning the sector's future to challenging for global leadership. The mines driving this surge, KCGM, Hemi, Cadia, and dozens of supporting operations, represent billions in investment, thousands of jobs, and a fundamental repositioning of Australia's gold industry. The opportunity is enormous for workers seeking stable, well-paid mining employment, for communities dependent on mining economies, for investors seeking exposure to gold and operational leverage, for Australia's economy benefiting from exports, taxes, and regional development, for the global gold market requiring reliable supply from Tier 1 jurisdictions. Mark Zepner is right. It is a great time to be in the business of gold mining, and the next 5 years will prove whether Australia can execute on this ambitious production growth. The projects are real, the resources are proven, the capital is committed. Now comes the crucial part, delivery. Australia's gold production jumping 30% by 2030? That's not speculation anymore. That's the plan. And these are the mines making it happen. KCGM, Hemi, Cadia, Mount Magnet, Mungari, Cowal, Great Fingal, McPhillamys, Ravenswood. The list goes on. Together, they're writing the next chapter in Australian gold mining, a chapter of growth, expansion, and renewed dominance in global markets. The golden age isn't over. It's just beginning.